Let's look at the data. S&P 500 futures are dropping 1.4%, and the VIX is seeing a volatility spike. The broad market is bleeding. Broad indices are down, yet specific subsectors see explosive upside. CF Industries is up 75%, alongside massive volume spikes in defense names like AeroVironment. The immediate panic catalyst is the US and Israeli strikes on Iran, pushing Brent crude past $90 a barrel. That energy shock is hitting an economy where the February payroll report showed a 92,000 job loss and unemployment rising to 4.4%. While the media screams about a macroeconomic collapse, dark pool data shows a completely different story of calculated accumulation. Smart money is executing a capital rotation into wartime assets to prepare for a stagflationary environment. Stagflation occurs when slowing economic growth, evidenced by that payroll plunge, collides with persistent, aggressive inflation. Energy supply shocks are the ultimate catalyst for this environment. They drive up transportation and logistics costs across every sector of the S&P 500. This energy-driven inflation forces the Federal Reserve to delay interest rate cuts, simultaneously squeezing corporate earnings and consumer spending. In a stagflationary shock, institutional capital abandons broad index funds and parks liquidity only in sectors that possess absolute pricing power and inelastic demand. Geography is the bedrock of this crisis. The Islamic Revolutionary Guard Corps has effectively closed the Strait of Hormuz. Combine that with the renewed Houthi attacks in the Bab el-Mandeb Strait, and you have a dual choke point blockade sealing off the Middle East. The disruption is historic. 19.4 million barrels of oil per day are currently offline. Over 150 tankers are currently anchored outside the Gulf because insurers have canceled protection and indemnity, or P&I, war risk cover. P&I is a form of mutual maritime insurance that covers liability for third-party risks, like cargo loss and environmental damage. This forces a mandatory logistics pivot. Carriers like Maersk and Hapag-Lloyd are rerouting entire fleets around the Cape of Good Hope. That reroute adds 3,500 nautical miles, delays cargo by up to 14 days, and burns an extra $1 million in fuel per ship. This geographic blockade has destroyed global supply chain liquidity, systematically repricing global freight and locking in structural inflation for months. The Persian Gulf functions as a primary artery for global agriculture, turning this blockade into a contagious agricultural supply shock. This breakdown shows the scale of the agricultural hit. Beyond the energy supplies, 30% of global fertilizer trade is now physically cut off from the market. This disruption has arrived exactly as the Northern Hemisphere begins its spring planting window. The price of U.S. Gulf urea ammonium nitrate surged 21% in just a few days following the initial strikes. Qatar Energy has declared force majeure, removing 20% of global LNG. That gas is the critical feedstock required to produce synthetic nitrogen fertilizers. The physical shortage of Middle Eastern ammonia and LNG translates directly into a massive price squeeze for global agriculture. Right now, institutional smart money is moving aggressively into North American nitrogen fertilizer producers, specifically CF Industries and Nutrien. These U.S. producers hold a structural cost advantage because they utilize cheap, abundant domestic natural gas for manufacturing. The divergence is massive. European natural gas prices have surged 60% due to the blockade, while U.S. domestic prices only rose 14%. CF Industries hit a record high, jumping 12% in a single trading session as Wall Street prices in the market dominance. This geographic energy arbitrage gives U.S. producers total market share and unprecedented profit margins, while the Middle East remains offline. The second institutional rotation is into unmanned aircraft systems, or UAS. UAS refers to the entire system of aircraft operated without a human pilot on board, including ground stations and data links. Militaries are reallocating budgets away from expensive legacy hardware and toward low-cost, expendable drone platforms. AeroVironment is the primary pure-play leader here. They reported a 150% year-over-year revenue increase, fueled by the deployment of their Switchblade systems. The company has raised its revenue guidance to nearly $2 billion, backed by a record $3.5 billion in contract awards. Kratos Defense is another major player, seeing a 72% year-to-date surge as it expands into hypersonic systems manufacturing. As the global conflict cycle accelerates, these autonomous tech companies are structurally capturing the overflow of wartime government spending. The final rotation is into cybersecurity, catalyzed by the March 6 Cyber Strategy for America executive order. The core directive of the order explicitly enlists the private sector to defend federal networks. Pillar 4 focuses specifically on hardening critical national infrastructure. This mandate forces an immediate shift towards zero-trust architecture. Zero Trust is a security framework where no user or device is trusted by default, even if they are already inside the network perimeter. Dark pool inflows are surging into sector leaders like CrowdStrike and Palo Alto Networks following the federal announcement. In a geopolitical crisis, cyber defense becomes an inelastic national security requirement that guarantees recurring revenue. Let's analyze the outlook. In the bull case scenario, the Hormuz closure drags on for 3 to 6 months, giving the fertilizer, defense, and cyber sectors absolute pricing power. As broader market liquidity dries up due to stagflation, short interest and legacy tech will squeeze higher, making these 3 defensive sectors act as the primary destination for capital. The bear case scenario involves a sudden diplomatic de-escalation in the Middle East. A peace deal would instantly crush the conflict premium, sending oil back to $70 and deflating the spikes in fertilizer and defense stocks. You cannot trade this environment on emotion. You must remain strictly data-dependent and track the institutional dark pool flows. Check the description for the tools we use to monitor these flows, including the public $20 promo, the Webull Bitcoin promo, and Mumu's NVIDIA offer. This analysis is for educational purposes, based on rapidly changing data. Stay disciplined and stay liquid. The macro environment has changed. Survival in a stagflationary shock means identifying where the smart money is hiding before the rest of the market catches on.